Hey everyone, Brian Bogner along with Greg Towner. It is time for our March Madness 20-minute market breakdown. And of course, there is a lot of madness going on here in March. I know we're at the end of the month, but we've got 3 point Hail Mary shots winning games, and we've got wars going on around the world. There's all kinds of things happening. So, Greg, let's get right into this. Lots been happening. We're for the first time in a while, I'd say in a number of years, we're starting to experience some market volatility here, right? And it's interesting. Normally, when we say no one complains about volatility on the way up, right, but on the way down,
Right.
right, we call it volatility, but it does happen both ways. But we are getting some downward volatility. Talk to us a little bit about what is causing this and things that are adding to the market conditions.
Yeah, absolutely, Brian. I mean, some of it's obvious, some of it, maybe is kind of in the back burner in people's minds, and there's different layers to it all. But I mean, obviously, if we're going to talk about what's impacting the markets right now, it's what's going on in the Middle East and war in Iran. And the obvious thing is the Strait of Hormuz being closed down essentially is spiking the price in oil. I mean, we haven't seen that strait be closed down like this essentially forever. And so oil is just skyrocketing. And oil is priced around the world, right? It's a worldwide commodity. And so the impact of oil increasing the way it has, obviously we all see it at the gas pump, but it just goes far beyond that,
Right.
right? I mean, you're talking about the way that goods are transported all over the world, the amount of oil that's used to go in all kinds of materials. And of course, it's not just the strait being closed. There's a lot of infrastructure
Hmm.
being damaged.
Right.
Oil infrastructure, port infrastructure, natural gas infrastructure, all of that is just a real mess right now.
Yeah, so I mean, obviously you can't turn on the media. I mean, the Iran war is by far the number one thing out there, and rightfully so. But there are other things that are contributing to the volatility as well, even before that started, right? Inflation, how the Fed's
Yeah.
reacting to that. Let's talk a little bit about that.
Yeah, absolutely. I mean, even before this, it started to look like the inflation data was, I mean, we'll call it sticky, but you could argue it was increasing.
Right.
So that was a bit of a problem. And now, obviously the current oil price is an issue. But as we look out past this war, whatever that is, and however that evolves, I think the risk is that more and more countries are going to be wanting to stockpile some of these commodities. They're like, oh my gosh, look what's happening around the world.
Mm-hmm.
We need to make sure we have all the commodities we can get our hands on. So
Hmm.
that poses more potential risk to inflation down the road. And all of that kind of puts the Fed in a tight spot,
Right.
right? The Fed here in the US has a double mandate, inflation and the jobs market, and they're going to have a tough time cutting rates to help the jobs market if inflation is increasing.
Yeah.
So,
What are some other areas of the market? I mean, we're talking, obviously, this is affecting stocks. It's affecting interest rates, right? Because, we're getting higher interest rates, stocks are on a decline. But any other areas of the market you're seeing some issues?
yeah, I'd say two other big things impacting stocks right now that maybe aren't grabbing all the national headlines, but certainly we see all the time. Private credit. We don't
Mm,
need to get into all the nuts and bolts of this, but basically a variety of loans that are more locked up and not as liquid, and people are concerned that that could be
right,
an issue in the financial markets.
right.
And then AI. I mean, obviously, we're big advocates of AI, both in terms of usage and the investment opportunities. But there's some negative things around it right now impacting the market, whether it be how it could impact certain industries or just the amount of cash flow that's being spent by some of these companies. So it's kind of impacting some of the bigger companies that have done so well for the market for years are hurting right now because of that.
Yeah, it really is a double whammy because, right, it's impacting industries, right? People could potentially be laid off. There could be massive job disruption, right, on AI, but it's getting this massive amount of investment in it at the same time, which has been
Yeah.
very positive for the markets as well. So how that all plays out, a lot of unknowns there. Okay, so we've been talking some negatives, all right?
Yeah.
Are there any positives out there?
Well, of course. I mean, yeah, we know everybody wants to focus on the negatives, but there's a lot of positives as well. I mean, first of all, everybody hears us talk about behavior.
Hmm.
To us, sentiment follows the price movement. So as markets go down, people get more negative in sentiment. And frankly, I think you would agree with me, sentiment probably needed a little checking of itself here earlier in the year. People were getting a little too positive, right?
Oh
They
yeah.
thought the market couldn't do any wrong. And so it's been coming back down to better levels. I wouldn't say it's, really negative by any stretch, but it's more neutral at this point. So it's not working against us, at
Hmm.
least at this point.
Hmm.
Also, the other thing with the prices of stocks in particular coming down, stocks had not looked like a good value. They'd been
Hmm.
pretty expensive for a while, and I'm not going to say they're pounding the table cheap now because of this pullback. That would be too much. But a decent valuation reset here, a little bit more reasonable valuations across the market, and particularly in a certain sub areas of the market. When you talk about valuations, part of that is not just the price, but it's the earnings, right? And so earnings right now currently are estimated to continue to grow nicely this year. We'll see, however this evolves, the war evolves, could impact that for sure.
Hmm.
But at the moment, earnings look to be growing nicely. So that is going to be a potential tailwind as well.
Yeah. Yeah.
That, one thing that I think people aren't thinking about or talking about enough, and this is really US centric, is how well positioned the US is in all of this. Just, in a lot of ways, frankly, out of sheer luck, right? Like, where we're located, our neighbors to the north and south, the waters to the east and west, all the commodities that we have access to, there's the
Right.
shale oil reserves, some other access to commodities, agriculture, and so forth. Natural gas, we have more natural gas than we ever know what to do with. So
Right.
the US is positioned well, and so that's a positive for us here.
Yeah. Yeah. So look, there, even though obviously we say this all the time, the headlines are negative, there's still some positives out there. And, so it's not as doom and gloom. I mean, we know fear sells clicks and or
Right.
gets clicks, right? So it isn't all doom and gloom. Talk to us a little bit about, because I've seen a couple headlines, oh, we're approaching correction territory in the markets. What does that mean? What, like, when you say, oh, the market's correcting or we're getting into correction zone, what exactly does that mean?
Yeah, the media loves to have definitions of each level of pullback and, and what that
Mhm.
means, right? But we've looked at different studies. There's different ways of looking at it, but the bigger one that we looked at, going back to 1928, how often do certain levels of pullbacks occur, right? So if you talk about, say, a 5% correction, on average, that happens a few times per year.
Yeah.
So we're a little over that now. I think as we speak, Monday the 30th, we're probably in the 7% or so range off the high for the broader S&P 500. So we've exceeded that, but that's not at all uncommon.
Right.
And 10% corrections, I mean, they don't happen every year, but they happen the vast majority of years. And on average, it comes out to about once a year.
Mm.
So a 10% correction, which, certainly we're not too far off, could happen, is not too unexpected. And then 20%, that's what people like to have as the definition of a bear market, right? So the last time we had one of those was in 2022.
Right.
So it's been, several years now. And on average, those happen about every few years or so. They're pretty lumpy. Sometimes they happen a couple times back to back, and sometimes they go a long time. But, corrections, they're just a normal part of investing. They never feel good. But if you're gonna get those kind of upside rewards that stock investing, has done historically, that volatility is really just part of it.
Yeah, no doubt. No doubt. So let's, we've been talking a lot about the markets and big picture and, kind of these macro things and corrections. Talk a little bit about what we here at Parallel are doing as a firm and how we're managing through this.
Yeah, one thing that we've always been believers in, Brian, is we view cash as an asset,
Hmm.
right? It gives you a lot of optionality to utilize during times of market stress or when certain opportunities arise. So as part of our normal, risk management discipline, we've, over the recent weeks and months, kind of raised a little bit of cash. We're not trying to make some big market call. We realize that's difficult to do, but we just want to make sure we have some cash available should those opportunities present themselves. And we have, dipped our toes a little bit in adding to some positions here of late to utilize some of that cash. So cash is an asset. That's one thing that we've been doing for
Yeah.
sure. And something else that we've really been doing, and this is not just because of what's going on right now, this has actually been a trend for months for us, and in some cases going back over a year. We've been more and more attracted to what you might call real assets, or you could just kind of more generally call commodities. We think that that's an area that's been underinvested for a long time, whether it be like new mines and that sort of thing. Um, as countries, as I talked about more stockpiling of commodities, I think you're going to see more and more countries want to be specialists in certain areas. They're going to want to have, more and more access to their own, oil or copper or what have you. We saw that with gold. Everybody was buying gold for their central banks.
Right.
So we've been rotating more towards those areas, and that includes energy.
Right.
We think that obviously it spiked here recently, and whenever this, the things calm down in Iran, energy might have a pullback for sure. But we think it has good longer term potential as well. And it acts as a good hedge, right? Because
Yeah.
when stocks broadly are going down because of an oil related incident, those areas go up. So you never know when they're going to work, but when they're in your portfolio, they can prove as a good hedge.
Right. Right.
Yeah. So
Good.
recently, Brian, we actually wrote a report on some of these themes.
Okay.
Yeah, and we're going to be getting that out here in the near future. I know our advisors have been using it with some of their clients, but we looked at, and this is several months ago that we wrote this, and
Yeah.
so it's really tied into what's going on in the world. But we think that there's these big key themes that are driving stocks for, I don't know, call it the next 3 to 5 years, maybe, could be longer in some cases.
Mhm.
And some of those areas that we think and we're focusing on are energy security. Obviously, this is really happening right now. Power generation, everybody knows all that's being used for AI and all of that, and all the old grid that needs to be replaced.
Right. Right.
AI itself, as we've talked about, is a huge theme. This whole deglobalization thing where countries are wanting to move manufacturing back to their countries, and again, back to the commodity stockpiling. And there's a bunch of other themes. Healthcare, for one. Healthcare had a great period during the pandemic and has cooled off for several years,
Right.
but we think money could rotate back there. So some really big themes that we think have some room to run here the next few years that we're focusing on.
Yeah. I think it's important to, as an advisor and as an investment manager, you've got to be able to spot and analyze and research and see these things when they're rotating and when they're happening, and then be able to adjust with it, because we've seen this time and again. Look, both you and I have been in the business since the late 90s, right? We've seen big booms, we've seen big busts, we've seen different areas that have done better than others, and some, not so great. But you've got to be able to be adaptive and flexible when you're managing it, because a lot of times what's been working is not necessarily going to continue to work. So let me talk just for a minute here, because
Sure.
we're sharing a lot about what we're doing. What should you do as an investor if you're listening to this right now? Okay, here's a couple things to think about. The news cycle is literally changing by the second right now. I mean, I remember one morning, headline came out, the futures were down. Headline came out, futures was up. What, 15 minutes later, headline came out, futures were down, futures were back up. I mean, it's changing by the second, right? We say this all
Mhm.
the time on this show: avoid the noise. Like, the best thing to do is avoid the noise, because that's what it is. It is noise.
Yeah.
It's important to know. I still, like, again, I'm in the business and I do it on my iPad now. I don't read the paper version, but I actually read the print edition on my iPad of the Wall Street Journal once a day. And that's the day after all that news came out, because it's curated and it's not just all these headlines that are coming at you, which let's be honest, it can turn you sideways.
Yeah.
So avoid that. Okay. Focus more on things that you can control, especially as an investor, right? What are things you can control? You can control what you spend your money on, right? Controlling your expenses. You control how much you save. You can control, your planning, having a long-term focus, developing a financial plan, adhering to that plan. Like, there are many things that you can control, even when all these negative things are going on out there, and focus on those things here. And it's so much more important in the time that we're in right now. So, all right, I think we're hitting our 20-minute mark here, Greg. What are some recommendations? We always like to close this show with some recs. What do you got for us today?
Yeah, I'm going to tie in a little bit with what you were just talking about, and I'm going to just, recommend to all the investors out there, really be careful. Don't get drawn into things that are just too good to be true. I see people more and more talk about things that they've seen somewhere on social media or something like that. promising these astronomical returns or, returns with no risk or something like that. And we, of course, know that's just not at all realistic. And even within the industry itself, sometimes, these things that are too good to be true, they're high cost or high fees. And, so if something, just use common sense. If something sounds too good to be true, why would that person be trying to sell it to you and not just keep it all for themselves. So just use some common sense and be careful what people are pitching out there.
Yeah. And I would kind of some kind of dovetails with what you're saying there. We're in a environment now where risk management matters. We've been very spoiled for a number of years where, we had the COVID blip, we had a couple little blips here and there, but for the most part, just buy the dips and you'll be fine. And the market goes up. Well, now risk management is mattering in the time that we're in. I like to say this a lot, and we'll close on this. It's not what you earn, it's what you keep. Because you can earn a lot. You remember markets and tend to build, and when they correct hard and fast. So it's not what you earn, it's what you keep. So we'll end on that. Thank you for listening, and you have a great rest of your week.